We This is Benzinga Live with Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have
breaking news. What is up, everybody? Happy Thursday. Welcome back to another episode of Benzinga Live. I don't really know how happy of a Thursday it is if you're out there long in the markets. Everything is pretty down today. We will do a quick check on the overall indices here using my Benzinga Pro. Quick rundown for the show today. Here in a few minutes, we will have Steve Kalajyian from TradeEasy.com joining us, him and his 30-plus monitors he has in the background. Steve's been spot on with his market moves recently, seeing where the key levels are, where the market's going. I believe he's still pretty bearish. So we'll be talking to Steve today, looking at the S&P 500 down more than 2% today after that strong day yesterday. We've talked about this before. This market, as long as the Fed is hawkish, no rally you can expect to be sustained. And today we will talk about why we're trading down so much, of course, because of that strong jobs report showing that, hey, the Fed has now gas in the tank to be able to keep raising rates the way it is. If the job reports came in today lower than expected, then we'd say, okay, we're already feeling the pain of rates rising. But so far, that hasn't been the case. And we talked about this yesterday, how the U.S. economy has been largely the little engine that could and just kept going no matter what's going on. People calling for huge recession, huge downturn. We haven't seen it yet, at least in terms of adding jobs. So right now you'll see, we can go over here quickly to our CME interest rates calculator. They're just basically calculating the chances of a 75 basis point versus 50 basis point hike on the next FOMC meeting. They're calculating this using, wow, that's actually interesting. This number over here on the right, this is the percentage of a 75, because look, current rates is 300 to 325, 375 to 400 would be another 75 basis point hike. That's what we've got in the past few meetings. This number was actually higher this morning, directly after that jobs report. I believe it was closer to 80. So that number's come down a little bit, but as you can see here, it's seen as more likely today than yesterday that we will get a 75 basis point hike. What's interesting, though, is if you look at it, still less of a chance than a week ago. And I do want to talk about this because I don't think it's as simple as, okay, we added jobs. Now the Fed needs to, or is able to / needs to keep hiking more. I think the main thing, right, we talk about the Fed having a dual mandate. Worried about two things, right? On one side, worried about inflation. On one side, worried about employment and unemployment, i.e. the labor market. But there's a third thing that whether the Fed, it's in their dual mandate or not, is watching and is worried about, and that's the housing market, because we've talked about this before on the show, how much of wealth for the average U.S. person is baked into their home ownership. Right? If you have a mortgage and you're 15 years, into it, and you've paid off half the equity on your home, you might have a few $100,000 invested in your home. And if the price of that asset that you've been investing that money in crashes 30, 40%, that's not good for anybody. So as we see interest rates rising, as we see the prices of homes coming down, If that gets worrisome to the Fed, even if we're adding jobs, that will go into the Fed's decisions to raise rates. So we'll tell you, trust me, the discussion about rates and about the Fed will be a continued discussion. We're not done talking about it. But like we talked about yesterday, we are seeing signs already maybe the first couple dominoes falling around the world of central banks saying, hey, we can't afford right now to be this hawkish. We can, the United States can right now, because our economy is in a better shape than a lot of other economies throughout the world. You can see that in the Forex markets, in the moves that's been happening in the dollar versus the euro versus the pound versus the Japanese yen. We're in a decent position compared to other countries. And you know, we will be watching more so how the Fed is going to take data like this, the jobs numbers, and again, we talked about this yesterday too, how much what the Fed is looking at in terms of lagging indicators versus should they be looking at indicators that might be more forward looking, showing us where expectations expecting to go. You know, we can look at break-even prices for inflation right now. You can see very much expected. If we get this, oh, I hate how they do this on the. So the 10-year inflation, I mean, it's at 2.1, the break-even. You know, inflation. This is showing that inflation's expected to come down. This is forward-looking. When you're looking at CPI, lagging, those are lagging indicators. Death by inflation or death by deflation? All right, Jonathan, we'll talk about Apple too. So Apple, of course, the big news yesterday, Bloomberg came out with a report. What was this? Late Tuesday night, saying that demand for the new iPhone 14 down. Apple is scrapping its plans to ramp up production. Not a great sign for Apple by any means. We saw Apple sell off yesterday, come back a little bit today, down another 4.3%. And we talked about this with our guests yesterday, that Apple, basically any type of weakness in the stock for the past 10, 15 years has been buying opportunities. Maybe not those same market conditions anymore, where just because there's a dip in Apple, just because Apple's down 5%, doesn't make it the easiest buying opportunity in the world. I think the expectation is here for a lower quarter, for earnings to drop. So right now, this is the market saying basically, hey, even with, you know, you had Morgan Stanley come out with a note yesterday saying, hey, the exact quote in the analyst note was that the Bloomberg report offered more bark than bite. Basically, it sounded worse than it really was. Once you dug into what Bloomberg was reporting about the iPhone demand, it wasn't really as bad as it sounded. But regardless, that doesn't really matter, I guess. The market's saying, hey, we're selling this off. We're expecting this to keep coming lower. I also know firsthand, I'll give you guys some, I don't know, yesterday it looked like different kind of institutional money managers and whatnot were selling some Apple shares as well. All right, guys, I see our first guest hanging out in the background, Mr. Steve Kalajyian from TradeEasy.com. Excited to see how Steve's been trading this market past few days. So without further ado, let's go ahead and give Steve our special intro. Bring him on the show. Mr. Kalajyian, how you doing this morning?
Hey, good morning, everybody. Hey, Aaron, how are you?
I'm good. I mean, the market's not good, but I don't know what anyone really expected. I hope no one really expected, you know, yesterday's rally to keep going, or that the bottoms were in.
You know, I've been with you now. How long? I just kept on telling you lower highs, and you know, I was telling my big community yesterday, right around 3:30. I'm like, good Lord, please let them gap up tomorrow. Please let them gap up, because I had nothing but sell divergences on the close. And we had a monster short around the 350 time period. S&P futures were trading about 52 and a half, 53. And I said around 350, I said, I can see a 20 handle drop. And boy, did we get a 20 handle drop. We got a 20 handle drop in about 6 minutes. And you can see why we're in a bear market. They go down so much faster than they go up, you know. And I don't think the lows are in. You know, I was talking to some people over the weekend, and there's a VWAP that goes back to 2000, 2,900 on the S&Ps. One other person that I know is calling for 1,600 on the S&Ps.
On the S&P, 1,600?
Yeah, but in the sometime the end of third quarter of 2023.
That's like another. That's another 50%. That's another 50% drawdown
well,
from
he's
here.
saying that. I'm not saying that. He's saying that. I was looking at the 28 level, 2,800 level. But here's the thing. On one of my indicators I look at, if you do the math going out, you're looking at the end of the second quarter, maybe mid third quarter of 2023. And the last time that indicator got into the range that I wanted that to happen was October of 2008. And we never looked back. And I think that indicator, when I get that indicator to that level, not to the level of 2008, but that indicator dips below a number that I am looking at, and it bases there for a few months, you will then create one of the biggest bull markets going for the next 2 years after that.
What is that? What was that indicator?
It's an indicator I have I have my own proprietary stuff.
But
so
what was it? What was it showing? Because going back,
we're back in 2008.
In October 2008, it looks like the SPY was trading right around 100.
November of 2008 was the last time this indicator was below that number, and it's been 14 years since then. And if you do the math, and it's on the monthly chart, so that's why you have to go out. If you go out 12 to 14 more bars, which brings us to like November of 2023, that's when I think the market will bottom.
Okay. No, I was just looking at it because, and this is, I was looking at it on the daily. These are monthly candles. From October 2008, that's this candle right here, the S&P went down another 30%.
Mm-hmm. Well, I'm just saying that I think I got the signal. I got the signal like the first week in November of 2008, but it never looked back. I mean, yes, it pushed down, but it was if you're looking to buy long term, that was the most ideal opportunity to get long the market.
And you're saying we have or have not seen that indicator yet?
We're probably three to four bars away from crossing that number. Then it has to base below that for a while, and that's why I'm saying that I think the lows are nowhere near in yet.
Yeah, Jay Rice in the chat's wondering what that indicator is as well.
Well, it's on my proprietary software. So I mean, it's because I spent 9 years of my life building the stuff I have.
Well, I'm not asking for specifics about it, but
I can't show it to you here. I just can't.
But is it showing something with volume, with price? Is it
based on price? No volume.
Based on price. Okay.
Yeah.
So just for context, for your buddy that thinks S&P is going down to 160, the last time we were at 160 on the SPY was August 2013. So we'd have to go back. I mean, looking at this chart, that would be from where we were at about 500. That'd be like a 70% drawdown from there.
Well, I mean, I'm not saying we're going there. I'm not saying that, but I do think there's a good chance you're going to touch that 2,900 level, 3,000 level.
Okay, so that would be bringing us around where we were when the market crashed to COVID, not quite to COVID lows. So COVID lows on the S&P 500, and this was very brief. In March 2020, got down to 218.
Okay. I don't know if we're going to get that low. That was 18,000 on the Dow, 18,700. I remember that.
Yeah. Some people have thinking we're going to hit COVID lows. I think I'd want to see how we react if we even get back to kind of this potentially support level of right before the COVID crash. Kind of the 30.
That means you're looking at the S&Ps, but that means looking at 2,500 on the S&Ps. That's 1,000 handles lower from here, and that's 8,000. Well, no, it's more. You're talking 1,400 handles on the S&P. So
no, I'm talking about pre-COVID, where we were sitting right here where my cursor was 320, and then we crashed down to 218. So I think the 330, 320 level, let's see how we react once we come down and touch there. If we blow through that, then yeah, we'll be talking about maybe 3,000 flat or 2,900 on the S&P.
Well, 218, the last sale was 264 on the spiders. I mean, that's 150 points. Wow, it's pretty. It's 1,500 points on the S&P. You times that by 8. That's 8,000, 12,000 points. So you're looking at 18,000. Yeah, you look double bottom. I don't see that though.
Yeah, we'll see.
But I the thing is that every time they lift their heads, they just get kabooshed here. The 10-year bonds really hurting the market though, really. And again, you know how my stance on the Federal Reserve, what they did here. So they kabooshed the economy, they kabooshed the stock market. They just sat on their hands, and I don't even want to get into it because I'm not a fan of them.
All right, let's catching up on the chat real quick. Jay Rice saying the only way we get that low is nuclear war, and that's possible with Brandon. Crypto Taurus saying looks like there's a gap around 350, but it could be next year before we get down there.
350 on the spiders?
350 in the spot. We're basically there. We're less than like a percent away from 350.
I'm saying, no, I think we're going lower than that. But remember that chart you had last week? We drew that trend line. We just kept on making lower highs, lower highs, lower highs, lower highs.
Yeah, I don't know what that was. If that was on the SPY or on Qs or what.
There you go. Beautiful. Look at all these low. If you just draw your trend lines, you're just constantly making lower highs. I mean, it's just, and you got a ton of overhead resistance. The only way you're going to penetrate this is by getting to a level, basing, making new lows, basing, making new lows, basing, and then boom, you're going to turn right back up.
All right. So, but on this,
yeah,
go ahead.
No, and the thing is, next year they were looking for 3 rate cuts. That's off the table now.
Yeah, I mean, this market, I mean, it's going to be, I opened the show talking about, the Fed and rates, and we'll be talking about the Fed and rates until we pivot. But with this chart where we're looking at now with my trend line drawn, I would expect eventually we'll get another one of these bear market rallies, hit that trend line, and then reject again.
Mm-hmm. Yeah, that could probably come sometime in the second week of November, I'm thinking.
Second week of November. All right, so you think we've got a ways in store before we get.
October is going to be brutal.
October is going to be brutal. Okay. What about any? I know you're watching the same stocks, the same 30 or so stocks, pretty much every day. Any individual names making moves that you find interesting?
I've been looking at this Micron. I think if it gets down to the 44, 45 level, I think you can have a pretty good rally on that one. Amazon, here's the one thing about Amazon. When we hit that new low, the 36.39, now we obviously made new lows this week. Amazon was about 100. And now we're making new lows, and Amazon is about 13 points, about 14 points above that low. So Amazon showing me a big buy divergence, right? So when the S&Ps hit that 36.39, Amazon after the split was about par, right? Now we made new lows on the S&P, and Amazon's still $14 higher. So I think if we do get any type of market getting caboose, I think Amazon's one of the ones to buy. It's just showing me a big buy divergence.
Yeah, and then another big tech name that I've seen making some moves the past couple of weeks, Netflix. I mean, even today, look at Netflix.
Netflix. You just took the words out of my mouth.
Even today, Netflix down only a little more than 0.5%, while the Qs are down 2.5%. So Netflix has been showing relative strength. Yesterday we had a good day in the market. Netflix was up 7%.
Yeah, it got upgraded. I again look at that, so you can see that we're making new lows, but Netflix is not making new lows. This is a monster technical bullish pattern. So any weakness in Netflix, I would be looking to back up the truck on Netflix.
Let's see. Netflix. Yeah, I mean, I think right now it's hard. Like I personally, it's up like 40% from its lows over the past 2 months. I don't know if that move is getting overextended. Let's see if we can look at it.
Here. I mean, if we're printing S&Ps 32, 3,300, 3,400, I would start nibbling at it. I don't think you're going to see those lows. I think that's a bullish pattern, actually.
I mean, yeah, the RSI on the weekly chart's only at about 40, so it's not necessarily overbought at all. Let's see that on the daily. getting a little bit more overbought, up closer to 60. But so it might have some legs to run here, but I'd rather wait and get in on a pullback.
Yeah, I said not to buy it here. I mean, especially if I'm looking for, in October for the S&Ps to drop another 100, possibly 300 handles points, then you could probably look to, buy Netflix.
Okay. Any other names we're looking at right now?
No, I think, people want to trade the market. They should be looking at the TNAs, the TQs. If they're looking for longs, I mean, those are the triple. I like when the markets, get pushed down and you get these extreme levels. I'm more of an index guy. I like the underlying ETFs versus individual names. You got to worry about the earnings and this and that. If you like the Russell sector, the TNAs are great. If you like the Qs, you can look at the TQQQs, which is like 7 times cheaper than the Qs. You got the other vehicles like the quids too. So there are so many different ways to trade the markets today versus I mean, like I said, unless there were some individual names like a Netflix or Micron or names like that or an Amazon, those are like of all the world that I live in here, those are the names I would be looking at.
What was that name again? Sorry.
Amazon, Micron, and was it Amazon, Micron, and like the TQQQs. If we get down to a point where the markets are making new lows on the S&P, I think Amazon would really participate.
Wait, you're gonna be looking at TQQQ soon?
Not now. I said if we get to a point that I think that if the S&Ps get down to maybe 34.5, 35.5, I would start nibbling on that. Even if they went down to 33.5, 34, I still think it's we're going to get a pretty good pop.
Yeah, I also been looking at this,
not for a bull market, for a trade only.
Okay. So once we, like you said, November, we might get one of those bear market rallies, and it could be kind of vicious. I like. Yeah, I mean this like TQQQ. I mean Qs. Like you're eventually you're gonna get something like we saw here from June to August, where you're gonna get some basically relief. Question is are we going to take out any of those previous highs? No, are we going to keep making lower highs?
You're going to keep making lower highs. You're going to normally a bear market. You should get anywhere between 5 to 6 lower highs before it's finished.
Yeah. All right. Let's see if we've got any questions in the chat. Jay Rice, good call. Netflix has earnings in 3 weeks. Let's see. Quantum saying Apple is sitting at VWAP right now.
Yeah, but they kind of warned that the iPhone 14s are not going. I mean, you gotta be careful here.
Yeah, I think it's not time right now to be impatient and start trying to add Apple because it's down 4%. No. I think right now, and again, it all depends on your time frame, how you're trading. If you're long term investing, it's going to be different than if you're day trading. But I think right now it's the time to kind of be patient. And if Apple gets down, we saw it get down to 130 back in June. If it gets down even below that, closer to 100, it does start getting interesting to add for a long-term position.
But you nailed it though. This is not a time to be impatient. We think that the Federal Reserve is going to overshoot. They're going to put the economy. You heard what Druckenmiller said yesterday. You're going to put the market in a tailspin here. You're going to put the economy in the tailspin. They completely missed the boat here, and they're going to try to save face. They're going to caboose the market. So this is not a time to be impatient. Wait, cash is king.
Yeah, no, I couldn't agree more. And right now, we're all kind of just waiting on the Fed. We're going to start seeing as the Fed continues to raise interest rates, like we saw today. The job market was strong, or the job report was stronger than expected. That gives the Fed more ammo in its gun to raise rates more, because it's saying, hey, the economy's still good. Eventually, you'll start seeing that jobs report come down. And like you said, the economy is going to suffer from it, and the Fed's going to be forced into a position that it's going to have to pivot. But right now, it's looking like that's very far away.
Yeah, I think, like I said, I don't think they're going to do any rate cuts in 2023. I think 2023 is going to be a bloodbath for the market.
Yeah.
Unfortunately, that's not what I choose to say. I mean, because I think that they completely mismanaged this inflation. Then they really sat on their hands too long. I mean, think of it: 7% 30-year mortgages I saw this week. Back in January, we were at what, 2.75, 2 7/8 for 30-year.
Yeah, I mean, and that's what this right now, and that's what I was saying earlier too, is I think at some point everyone's looking at the labor market. They're looking at inflation in the labor market. But if you start looking at the housing market and we see the mortgage rates go from 7 to 8 to 9, and all of a sudden house prices are falling and no one's buying homes, then eventually the Fed's going to have to start looking at that too.
Yeah, but they may take longer. Look how long it took them to raise rates for inflation. They may take, it may be, we may be in the doldrums for a long time before they decide to wake up.
Yeah, right now,
very slow.
Right now, Powell has had no good reason to even consider having to slow down the rate hikes or pivot whatsoever. Other countries, you have starting to see the central banks starting to at least give some idea that, okay, we're not going to be able to raise rates that high next time, whatever, some central banks across the world. But here in the U.S., Powell has all the power in the world right now to keep raising rates as quickly as he wants to because the labor market looks fine. People
where was he when the first CPI number was higher than expected that pushed the interest rate of, inflation?
He was standing up there saying that the inflation was going to be transitory.
Yeah, he was wrong.
He was wrong. Yeah,
right.
100%.
So in my 40 years, I never heard anyone like a Jeremy Siegel rant and rave on CNBC how bad the Federal Reserve has managed this inflation.
Was that the Wharton professor?
Yeah.
Yeah, that was that was kind of controversial on Twitter and stuff. People were sharing it. What did you think about his position?
I guess I've been saying this for about a year, 8 months to a year. When the Dow made a new high and the S&P's hit over 4,800, I was jumping up and down like a baboon, saying I'm in this game 40 years. I remember when the Dow hit 10,500, Fed funds rates were 4.5, 4.75. You have a new high on the Dow, new high on the S&P, and you're at 0.25%. I said, something's wrong here. These guys are missing the boat. How could you have 0%, 0.25% interest Fed funds rates at new highs on the Dow, 28,000 points higher than when you have 4.5, 4.75 when the Dow was at 10.5 many moons ago? Remember, I'm in this.
Yeah, and that's what. Sorry, I forgot the Wharton professor's name, but he was talking about that Jerry Siegel, the pendulum that
right.
we were way too dovish, way too easy for too long, and now the pendulum has swung the other way, and they're being way too for really no good reason. The way I see it, we haven't seen it. There's no data, there's nothing indicating that if the Fed keeps raising rates, that inflation hasn't come down at all. Really, it's all it's done is just made things harder for a lot of people. So I don't know. I mean,
these people from the Federal Reserve, they're just like you and I. Okay, they go to the supermarkets. They see gasoline pricing go from $2.50 to $5. They see natural gas going up. They go see milk go from $2.25 to $3, almost $4. What plan are they on?
Yeah, I don't know.
What plan are they on? I mean, seriously. Maybe they're not building an extension on their home and see lumber prices go 40% higher. But what planet are they on? Right? That's what Jeremy Siegel's trying to say. And never have I heard in all these years of my life someone that critical of the Federal Reserve outside of myself.
And I agree with you because I was watching him like, thank God someone's saying this, like what I'm seeing. And then I saw on Twitter people saying, oh my God, this professor who has no clue how economics works is on CNBC talking about it. It's like, no, like he's making good points that no one else is.
Making very good points. I mean, if you ever get me on CNBC, they would yank me off, or because I would use up all the oxygen.
I'll try to get him. I'll try to get him on this show and try to get him as fired up as he was on there.
Oh no, get him on with me. I'll tell you, we'll complement each other.
All right, I'll try to make that happen.
All right. Well, I mean, he really, for the first time, here's a guy who's a roaring bull, and there were many times I disagree with his philosophies, right? But on Friday, I stood up and gave him a standing ovation. Really.
Yeah, no, I mean, again, I for the interview saying it wasn't, right. And then you had business. I know Elon Musk came out and said something about the interview saying he was right too. So, yeah, we've got any final questions for you? If not, do you have any, final words, final thoughts you want to leave us with?
Yeah, book me on the show with Jeremy. We'll really give the audience a good understanding of economics and what.
All right, let's do it.
Wrong.
All right, Mr. Kalajyian, have a great rest of your Thursday.
Day.
Enjoy your weekend. We'll see you next week.
You too, brother. Have a good one. Take care, everybody. Bye-bye.
All right, everybody, smash the like for Steve Kalajyian. You can find more from him at tradeeasy.com. Always a pleasure to speak with Steve. Someone make a note. Someone remind me that we got to get Mr. Professor C. He's got to be pretty big time, huh? We can get big time. We're going to get more big time guests on here. I got someone's phone number at a conference I was at a couple weeks ago in New York City. I'm not going to say whose phone number it is, but someone I can text now who's going to come on the show. So we're going to get some more big names on here. Speaking of big names, Rob Roy, Mr. Robert Roy from tradinglikeaboss.com will be joining us here in about 20 minutes. Yeah, he's a big deal. I also, coincidentally, I was connecting with a PR rep today who does communications for a network of a bunch of different professors throughout the country. And I was like, yeah, man, any econ business professors you want to send my way, let's do it, because why not, right? We can learn from the people like the guy they had on CNBC, like the Wharton professor who gave that interview. Honestly, let's go ahead and find that and play some of it, because I just don't want, it's bad content that we're talking about this without, with some of our audience might not be familiar with what we're talking about. So Wharton professor Jeremy Siegel fired up on halftime report over the Fed. I loved this, and then maybe what we can do is see some of the tweets that I was talking about. How some people, for whatever reason, really like we're not down with it. We're not down with what Mr. Siegel was saying.
Honestly, we're giving him too much of a, oh, good, he's standing against inflation. We're giving him too much praise. I mean, listen, the Fed has just, executed the last 2 years one of the biggest policy mistakes in the 110-year history of the Fed, by staying so easy when everything was booming and pointing to, my God, inflation is going to be a terrible.
So his first point here, and this is with the same point that I think a lot of people who are bearish right now made. Oh my God. Holy cow. All right. Something just, wow. All right. His first point, which a lot of people that are bearish right now made, is that the Fed initially screwed up by staying so loose, so easy, so dovish, while everything was ripping. The market was ripping in 2021, the labor market. And to the Fed, or to the Fed's credit, I think there was a lot of people who were saying, why raise rates now? Unemployment still isn't even back to pre-COVID levels, all these things. I'm in the camp where I agree that probably should have tried to get everyone back to work when we were to where we were before in terms of unemployment. Could they have started, throwing in some quarter point raises here and there? Probably. The market wouldn't have liked it, but we probably wouldn't be in the position where we're at today.
Terrible problem. And now, oh yeah, we did goof badly there, which he never really admitted. I mean, he still blames some things on Ukraine and Putin and the supply side, even though oil is way below that level, way beyond that. And now we're saying, oh my God, he's the God that's going to stop inflation, and he's going to crush the wages, which have fallen behind inflation by 3, 4, 5%. You can't have cost push inflation when you're lagging inflation. You can't blame wages for inflation when they're 2, 3, 4, 5% behind inflation.
Sorry, we're going to go back and watch this part again, because I think this is a very, very important point.
There, which he never really admitted. I mean, he still blames some things on Ukraine and, Putin and the supply side, even though oil is way below that level, way beyond that. And now we're saying, oh my God, he's the God that's going to stop inflation, and he's going to crush the wages, which have fallen behind inflation by 3, 4, 5%. You can't have cost push inflation when you're lagging inflation. You can't blame wages for inflation when they're 2, 3, 4, 5% behind inflation. I mean,
He said the other
why
day
is he
that they're
putting
gonna-
the burden
they're gonna-
on these working
said the
people,
other
on the
day-
employed people? That's, I mean,
Professor,
what
the
is,
Fed-
and
the Fed
every other
chair-
commodity price is going down.
The Fed chair gave you no indication the other day that they're stopping anytime soon. I mean,
That's
he was
right,
pretty
and
ex-
that's
he
why,
was pretty
and that's why the
explicit
stock market
about
has
that.
cracked this week. He gave no indication that, I mean, if he would have just said, I see some favorable signs, like housing prices are not rising and actually they're falling, or
So, one of Professor Siegel's points here is that instead of looking at things like commodity prices coming down, house prices coming down, they're looking at wages, which lag inflation, instead of these things that that you see coming before inflation. You see, housing prices cool off. You see commodity prices crashing. How could you look at, all these things that I saw a chart yesterday of all these goods, whether you're looking at chicken wings, avocados, lumber, that have come down 50+% from their highs, and not have the wherewithal to know that these commodity prices crashing are then going to be, seen in inflation throughout. You can look at some of these things and say, yeah, we are seeing signs that inflation's cooling down. We are seeing signs that this is working, instead of putting this burden, like Professor Siegel's saying, on the everyday working person by continuing to crush interest rates. Because look, at the end of the day, it's not going to be people, the ultra wealthy that are feeling the pain from this. It's going to be people that are laid off from their job because their companies aren't able, because companies now, it's more expensive to borrow money and to grow, or the hiring freezes that are going on, so people can't get jobs right now. Anytime, right? And here I have a good graphic for this. I gotta find it, and we'll play the rest of this interview real quick, because again, I can't give Professor Siegel enough credit for coming on here, speaking his mind, being fiery about this, because clearly he's passionate about this.
some little thing that our policies are working. I mean, he admitted, there's long lags. Well, if he keeps as tight as he is, look at every market indicator, the Dow, the commodities, real rates, the money supply, everything is showing one of the tightest Feds or intentions of Feds that we've ever had.
So what
He says
so
there,
Professor,
and he says it works with the lag. Well, if he stays this way through 2023, you can, make sure that there's a major recession on the other side.
So again, our essentially what Siegel's kind of saying here too is the Fed goofed, messed up, kept rates too long, and now the price that we all have to pay for that potentially is the Fed raising rates to engineer a recession. Because at this point, that's what is going to bring inflation down. That's what Powell has said they're going to make happen, even if it means, unemployment rising above 5%, all these things. He said there's going to be pain in the labor market. He basically reading between the lines, saying the quiet part out loud, we need a recession to slow down inflation. I'm not really okay with that. I'm not okay with the policy being, we're going to engineer a recession here to battle with, this inflation. So here, let me pull up this graph. This is from RBA QTC. Responsible Business Alliance. What's the QTC? All right, honestly, I don't know what these. I don't like to do this, but I don't know what the exact source on this. So here, let me fact check this real quick before we get going. RBA QTC. Okay, I got it. All right, so RBA is the Responsible Business Alliance, the world's largest industry coalition dedicated to corporate social responsibility and global supply chains. QTC is a medical provider. So I think some of the data on this is coming from, how do I open? Okay, here we go. There we go. So this is market looking like 07. Fact checking is far left. All right, Lisa Lee. Sorry, I wanted to make sure that the information I wanted to display on the show came from reputable sources. Didn't realize that was far left of me. The brilliance of fighting inflation with high interest rates. Even using a mainstream model, you get this. We get poorer instead of richer. GDP falls. That's obvious, right? If you raise interest rates, you're bypassing growth. Unemployment up instead of down. Social breakdown, more crime, suicides, depression. So I think the more depression, crime, suicides, that's the part that's coming from QTC. And you can see here on the bottom sources, RBA, QTC. Rentiers, capitalists get richer. Workers get poorer. Wages drop more than prices. It means rents and profits become a larger share of GDP. So basically, my point is just that raising rates in this environment will end up screwing over everyday people more so than the rich, the wealthy, and that, you know, is the price we pay for the Fed goofing up. But again, just like basically every other, I think, you know, things, they're going to be okay. Let's again, not to make anything political on this show, but just real quick, Lisa Lee saying that this is the Fed's plan regardless. We're keeping in mind, right? The Fed is led by Jerome Powell, a Trump-appointed Republican. So if your whole thing is saying that this is Brandon's plan, the left this, the left that, the Fed, just remember that, okay? You know, and then we can try to have a civil conversation about, because it is true, right? The Fed is supposed to remain politically independent, do what's just best for the country financially without political influence. But just like the Supreme Court, I mean, of course there's going to be political influence. We saw Trump urging, and just like Siegel was talking about, the Fed goofed by keeping rates low. I'm not saying this was Trump's fault. If anything, it's Powell's fault for listening to Trump, but Trump was urging Powell to keep rates low. He went bad. He went, oh yeah, Powell's run by the deep state now, I'm sure. Jesus. Bye, Jimmy. All right, again, and I didn't want to, let's go back to our Benzinga Pro. Pull up some, actually, what I also wanted to do was see, I wanted to show, I guess, because I didn't like this, I guess, that how many people on after that interview we just played were you know, saying that he was wrong, didn't know what he was talking about. So I'm just going to do this. Professor Siegel. And you can just see some of the tweets. A lot of people were lauding him. Some people, the opposite. Who is the person that said they were still in his class, or still in his class in the chat? That's a small world. The time to start raising rates was cute. Yeah, that's fair. I don't think the blame should fall on either administration. It should fall on the man leading the Fed, Jerome Powell, and the other Fed presidents. There's like, how many of them? There's 12 of them or so, you know, around the country. Like it's I'm sure, you know, there were probably some people, whether it was people more on the dovish side, Charles Evans or Lael Bernard, there were probably people there that thought, okay, maybe this is a little extreme, who maybe wanted to speak up, who couldn't. So, yeah, see, I mean, I kept seeing so much stuff like this. You know, wait, and hold on. Where do I know that name from? Henry Blodgett. How is this bad? We just looked at the 08 chart. Here's your reminder that Wharton professor Jeremy Siegel is absolutely clueless, and he shares a headline from November 6, 2008, when he says stocks are dirt cheap. If you bought stocks then, they were dirt cheap. They went down for a little bit after that, but that doesn't mean they weren't cheap, and that doesn't mean your returns wouldn't have been good. Well, let's go back to all right. So he's saying, here's your reminder that Wharton professor Jeremy Siegel is absolutely clueless. And I was seeing a lot of tweets like this, mostly from people that are still bearish. And I think it's because a lot of people that are still bearish see that this recession as a necessary factor, a necessary thing to bring inflation down. That's where I disagree. But okay, let's go back to our Benzinga Pro. Look at this. This is the worst, in my opinion. This is, how can you dunk on someone for this? Go to SPY. We'll go back to our monthly chart. Here's November 08. Here it is. He said stocks are dirt cheap when the S&P 500 was trading at 93. It went down another little bit to 73. And so if you bought here when Wharton, oh my God, within, a year, you were up more than 30%. That's not bad for a year, 30%. The bigger problem that I have is I disagree with the Fed is their balance sheet expansion was still buying mortgage back 6 months ago. Look, I don't care. It doesn't matter, I don't think, how you look at it, what your grievance with the Fed is. The bottom line, I think we can all agree, hindsight's 2020. There were mistakes in the past, and now it seems like, to me, they're willing to say, okay, we're going to make a new mistake to try to make up for our old mistake. But what did your second grade teacher teach you? That two rights don't make a wrong, or two wrongs don't make a right. Two wrongs don't make a right. So they were wrong to be too easy. Sure, I think we can agree on that. Whether you're looking like Jay's talking about the quantitative easing, the adding to the balance sheet, or we could be talking about how right now, are they being too hawkish? Is this too extreme? Is what's happening to the stock market, to everyday people? And again, remember, it's not just wealthy people that are affected by the stock market coming down, right? Teachers, firefighters, police officers, all these people have retirements in their pension. So if you're out here in a camp that's rooting for a complete stock market collapse because you hate Wall Street and you hate bankers and their political, like, sure, I can actually get down with a lot of that. But that doesn't mean I'm still rooting for a huge stock market collapse, because I know that's bad for a lot of everyday people. I'm in the camp that I hope we can see some of these Wall Street reform, things that I think people want to happen without some big, absolute collapse. But I think a lot of people would argue with me against that the only way you're going to see any reform, the only way you're going to, and that was the case with 07 and 08. We got a lot of banking reforms and security reforms after 07 and 08 because it was necessary. And a lot of people are basically like, yeah, you're not going to get that without that here. How we recover is key. Right, I agree. We're at where we're at. There's nothing we can do about it now. Hindsight is 2020. But I'm saying instead of the Fed, I think wiping the slate clean and looking at this with a clear eyes and saying, all right, how do we want to deal with this situation? And honestly, to me, and I think Professor Siegel would agree with me, the answer is to say, all right, let's become truly data dependent. And when we say data dependent, let's not just look at lagging indicators. Let's look at things like commodity prices crashing. Let's look at things like global freight prices showing that demand, not just here in the United States, but around the world, is dipping, and saying, hey, we can continue on the path we're on and absolutely crush global demand, create a recession, potentially not only here in the United States, but around the world, which again, we know the personal impacts of recessions, right? Suicide rises, crime goes up, depression. If we're okay with all of that because the Fed goofed and is now trying to make up for that by being hard on the other side, as the analogy Professor Siegel gave was a pendulum. On one side of the pendulum, they swung too far and were too easy for too long, and now swinging too hard here. To me, the downside of this pendulum being too easy, the downside is assets get inflated, the stock market goes up too much, inflation is too high. That causes pain. That people at the grocery shop, no doubt about it. But the pendulum on the other side, the downsides that come with that, to me, is a lot worse, right? You're talking about the difference of people having to pay 10% more at the grocery store or losing their job and not being able to go to the grocery store at all. Again, that's the point I just made. The alternative, I'm not saying that there's no pain on this side of the pendulum. I'm saying that right now, as we increasingly look like we're heading toward a huge, recession, that downside to me is more severe. That pain to me is going to be felt, or in my opinion, is going to be felt more than people having to pay, 10% more at the grocery store and 20% more at the gas pumps. Again, so in my ideal scenario, right, the pendulum wouldn't be swinging too hard to either side, and right now, that's where we're at. Overcorrect. It's like they're driving a caravan, yeah, or a field goal kicker, right? The Fed missed one to the left the first time, where they were too easy for too long, and inflation rose up, and then they said, okay, we gotta go to the other side now, and then they ended up missing to the right. When the field goal's right there in the middle. All they have to do is kick it straight. Rich is calling for, all right, we have two very, very different, let me see if I can find this. Two very, very different Nvidia predictions here in the chat. Someone earlier said huge squeeze going to 170. Let's see if we can find it. I don't know. There was a comment from a while ago. Someone said Nvidia coming up to 170 on a squeeze, and this person's saying it's going down to 70. Yeah, I think we're not in a big recession. We just added jobs. Jobs report was strong. Nvidia target for me is 72.80. We can look at Nvidia, and I talked about this on the show with Options Mike the other day. And I'm the least bullish on Nvidia that I have been over the past 3+ years. We talked a lot about the company's new graphics card that's being perceived horribly among its core consumer base, its customers, primarily gamers. This new graphics card was too expensive, they said, and it's bulky, and it's really not much better, basically, than its previous model. You have that, the fact that their core consumer base doesn't like it, in addition to the fact that an additional consumer base, crypto miners, have no need for this new graphics card. So I'm out on Nvidia right now. If I'm Jim Cramer on Mad Money, I'm saying sell, sell, sell right now. Still love the name long term. I'm like, I think Cramer's dog's name is Nvidia. I'm with Cramer that I like it long term, but right now it's a sell to me. If you're asking me in the short term to intermediate, I don't like it. If it gets down, I'll tell you what, the people in the chat that's saying it's going down to pre-COVID levels to 70, I'll start adding to Nvidia way before that. I'll start adding at 100, at 90, at 80, and if we get down to 70, we'll get down there. Yeah, not a good sign. It's like if Ford put out a new truck. If you were like, yeah, truck guys are pissed at Ford, probably not a great sign. If your main consumer base is not happy with you. Good to trade for now. Yeah, these high tech are these names, like your growth names. I saw someone in the chat saying Roku making new lows. All these names are getting absolutely crushed today, down 5%. And hey, it doesn't matter what stock you're talking about, as long as the company has, as long as the company is like an actual legitimate company that's going to be around, that makes some money, whether they're gross profitable or not yet. Eventually, some of these names get down to a position where people are willing to own them. Not for every name. Again, there will be names, if the Fed keeps on its path, that completely kaput. Bird Scooters comes to mind. Man, I don't know. This, what was it? I think it went public at a $2.5 billion valuation and is now trading at below 100 million market cap. It was either $1.5 or $2.5 billion, and that's the nature of the markets, right? In private markets, it was valued at $2.5 billion. You put it on the stock market, and they said, nope, we don't think so. Hey, Noli. What up, Noli, in the chat? No, Crypto Taurus, I don't think it has anything to do with your base. Are you talking about Nvidia's base? Is uneducated? I don't think it has anything to do with that. I think it just has to do... I think, if anything, the gamers know what the fair going price for the graphics card is, and then they're upset that that's not it. Let's go ahead and bring on our next guest, Mr. Rob Roy. Missed Rob Roy last week, so excited to get him on this week. Without further ado, let's go ahead and bring our first guest, or our second guest of the stream on. Give Rob our special intro. Bring him on the show. What up, Mr. Roy? How you doing?
Aaron, how are you, sir?
I am good. I mean, the markets could be better, but we could be saying that a lot these days.
Yes, absolutely. It is interesting. I mean, we had this great head fake yesterday. A lot of people jumping in long, trying to get that early buy. And how's it going? The Disney movie, off with her head. And here we are, back down to the lows again.
Yeah. So, I mean, we saw the jobs report this morning. The Fed looks like it'll be able to keep hiking. I mean, do you have any levels here? We'll pull up your chart here. What are we looking at?
So we're looking at the S&P right now. You can see this line up here at 38.55-ish. It's not exact, but I don't need the pennies in there, but that's our 20% pullback. So we're at about 24, 25% or so now. I didn't measure it today. I've got a little calculator I use for it normally. But right now we're holding. You look the last, couple of days, we can't break this 36.15.74 level. And listen, I know there are people that look at this, Aaron, and say, man, this is just a bunch of hooey on the chart. You're drawing lines, and sooner or later it's going to stop at one of them. It doesn't quite work like that. We're not talking about sooner or later it's going to stop. We're talking about where you see reversal points. And when you do, they're key reversal points. Look at this one. Look when we drew this fib was drawn off of this high down to this low, which came on this day. From that day, we waited for the bounce. We got the bounce. It moved up to our 236, which is our hesitation level. And then we exploded for the next 3 days. They were key levels. They work. We're putting in a bottom here right now. When I say a bottom, we're putting in a base. I don't think we're bottom anything yet. I think it's a fallacy to believe that we've stopped going down right now. I think we've got 40-ish% or so total we're going to see to the downside before we stop that overall move. Listen, I've been wrong before. Ask my wife, she'll tell you. But that's where I'm looking, is at least 40%. And when we look down here at this brownish line, which is our 33.82 half level, that is the next fib midpoint. We've got this black line here of 41.81, Aaron. And we've got another black line just a little bit further down. I really got to scrunch the chart up. Sorry about that. There it is. Our next one is 25.84. This brown line is in the middle. That's where I expect us to go to next, 33.82 half. I've heard some others talk about levels near there, that 3,300, just 3,400.
So that would bring us back to basically where we were at pre-COVID.
Right. If we go back and look at let's go look at a monthly chart on the S&P. Right. Sorry about all the mess of the fibs back there. But we're looking at that midpoint is right about here. So, we were at 2191 early on in 2020, right? That was our low that we bounced off of in early 2020. All right. So it is, and here's the 25.84. And all we're looking at is putting that level in the middle of these two. That's all that is that midpoint. So we've got a little bit of room to go, but I don't think we're done. I think we've got at least 40%. If you look at the last two major corrections for 08 and 2000, we were 50 to 60-ish% pullback in there. We're only 25, 24, whatever it is today. That's all it is. I don't think we're done. And I think there's a lot more to this one. There's other complications. It's not just the market. It's the war in Ukraine. It's what the war in Ukraine is doing to places like Europe, that how they're going to get hurt this winter with energy and and now we've got nuclear war threats, right? And then what is China doing with?
But it's kind of a two-sided sword where the worse things get, whether you're looking at here or around the world, the closer we are to central banks being forced to pivot and give some relief, right?
They're going to have to. I mean, I have a person on my own team who was scheduled to move from where she lives now to another state, a much warmer state, actually. She'd have about 150-degree difference in the winter, but her winter compared to their summer. And she can't any longer because now with interest rates going up to 7%, she said, that kind of prices me out of the market I was looking to move to, and I'm not able to do it right now. So, and I think a lot of people are sitting there. When you look at mortgage, the number of mortgages being written every year or every month now, every week. I have a good friend of mine who's he does the notary stuff for mortgage. He's a mobile notary. He goes house to house to house in Washington State, and he's got no business any longer. He was so crazy. He was doing 1,400 miles a week. He's doing 100 now, 120. He's got no business. Because people aren't taking mortgages.
Yeah, and that's what I was talking about that earlier too. That we talk about the Fed having a dual mandate, looking at unemployment or the labor market and inflation. But if we see some like serious pain in the housing market from the mortgage rates going too high, they're gonna have to look at that too, because so many Americans have their wealth baked into the ownership of their home.
Yes, and multiple homes. I have more than one property in Buffalo, New York, that we have people that are not able to pay right now and trying to get government assistance. We have one that's on their 5th month. And even after we filed an eviction notice, and I feel for them, but the bank still wants my mortgage payment. Go figure. My tenant won't pay the rent, but my bank still wants the mortgage. We filed an eviction notice and to get them to pay. And the judge said, well, we're just going to give them more time to see if they can come up with the money. Okay.
Yeah, and that's why I think right now, like, what did the mortgage rates go? They're at 8% right now or something crazy?
It's ridiculous. Yeah. It's crazy.
And I think I saw that in July or maybe it was August, house prices fell at their like fastest pace since the Standard Poor, the S&P started tracking it.
You know, there's so much wrapped around this. I get the Fed mandate, and you have to look at that through rose-colored glasses a little bit. You've got to look at that when they did that mandate. When did they create that? Who was buying stocks? It wasn't the butcher, the baker, the candlestick maker. It wasn't the average person. It was the wealthy and ultra wealthy that were investing in the markets. So the markets were not their concern. Now you've got to ask, how many people do you know? If you took 10 people that you know, how many of them have a Robinhood account now or some form of account like that where they've thrown money in the market, whether it's at Bitcoin or Forex or just trying to buy stocks because somebody said, ooh, this is a good place. You should buy more XYZ stock now. And they bought it there.
Yeah, and I mean it's I think right now people are looking for it was for I was just talking about earlier, the pendulum swinging. It's like for a long time, for the last 6 months or so, inflation has been the biggest worry. But at what point does that shift? And now people are worried about, getting laid off from their jobs or from this or that or from other things that you might see in a recession that are more painful than paying an extra 10% at the grocery store or an extra 30% at the gas pumps.
Right, because the government's unemployment check is only going to take you just so far. And even if they come back and start doing some of the crazy stuff that they did where, everybody's eligible for unemployment, just take it. My daughter lost her job when she worked in a gym. She lost her job. Physically, the gyms couldn't open up. She got unemployment, and then it took her weeks at the end of it when tax season came around to prove that she was actually eligible for that with a notice that she's going to have to pay all that money back. Right. So we made it so easy in the beginning and so difficult on the tail end of it. Right. And so many individuals look at the return to work, right, back on location versus home. People are saying, I'll quit my job. And I have many people telling me now, I'm happy I got a job. I'll go back to the office if that's what they need me to do. I'm not saying right or wrong on either side of it, but we're going to run into this unemployment issue yet. It's going to happen.
Right. And that jobs report today, kind of conveyed the opposite, which is why the market, reacted the way it did. Because it's one of those things where bad news is good news and good news is bad news. If the jobs report had been, oh, we had to lay off 200,000 people last month, the market would have been up today because it would have been seen as we're closer to the Fed being forced to pivot. Of course, with these jobs reports, I don't think they're ever, they'll revise it a month from now and whatever. But, no doubt about it, as the Fed continues to raise rates, eventually you'll see that jobs report start looking bad, start looking for more what the Fed's looking for in terms of the labor market slowing down. But to me, this steadfast commitment to raising rates at no matter what happened, it's just silly. It's like, why can't we try to be more middle ground and say, okay, we're going to be data dependent, see what happens. We're looking at some things that show us that inflation's coming down. We're looking at other things that we're still worried about. And I think that would be a more reasonable stance to be in right now.
I agree. And you've got, when it comes to the labor report, I'm taking back a few years now, though, but there's a coach that works with us. He works for Wealth Builders. He teaches for Wealth Builders, Ryan Litchfield. You'll see him. He was co-author of Gregory Morris's last book, Candlestick Charting Explained. Ryan, I would only hope to know just the things he's forgotten in his life about the market. That's how brilliant he is. He teaches,
who is this? What's his name again?
Ryan Litchfield.
Ryan Litchfield. Okay.
Yep. He teaches very high level when he does. Okay. He's got an amazing trading system where he puts you through drills, hundreds of them in the course of 2 days. Hundreds of drills to get you making decisions, yes or no, in or out, buy, sell. I mean, very good at what he does. We go back, and he and I are trying to figure out some unemployment numbers one time, and he went to the point of getting on the phone and going up the ladder with different government officials in the Labor Department. And we came to find out, now I don't know what, if anything has changed, but the sampling they told him that the Labor Department uses is not much bigger than ADP's sampling, which blew my mind. How does the government not know who's actually on unemployment? I mean, you're the ones paying the checks. Somebody's paying them. I mean, I would think you could hit enter and say, "Ooh, that's how many people. That's how much we spent this month." And they said it's not much different than what the ADP sampling is. So I don't know how accurate the numbers are at times. And I'm not saying that they're fudging numbers. I just have to question what's happening with those numbers. I see more and more people hiring people easier now. So I don't know if unemployment's actually going the way that it shows, and remember, anybody who's been on unemployment for more than 6 months drops off. They don't count any longer. They're not on unemployment any longer. So all those people just go away. It's only those that are actually collecting on unemployment that have come off for whatever reason. We take them off the list. So if 200,000 people stop their last week's check, after the last week's check, they're not on unemployment any longer. They don't count. So the accuracy or the numbers there, we've got to be cautious of. I think the Fed is going to drive us to a point that they're going to hurt the market if they continue the move that they're making. But I don't see that mandate changing anytime soon.
Yeah, I don't either. I don't see it changing. It doesn't mean I agree with it. Let's see. So you pointed out around the 3,300 level on the S&P. Any other charts, individual names maybe you've been watching?
So we took a couple of trades today. We did an Apple trade. And listen, guys, you could try directional trading things today. To me, it's very difficult after big moves down. Many of our trades from our morning show were washed before we even started. There was nothing that you couldn't get a directional trade on. I wouldn't take it. You had stock that normally moves $5 a day, and this stock gap's 14. Well, I'm not taking that trade. Not directionally. Will I take it as a spread? The answer is yes. So Apple was a great one today. They came out. They got two notes on them. They got a downgrade from Bank of America, and then somebody else upgraded, and they were a smaller company. And they said that no downgrade. We see them going 25% higher, and they may in the longer term, but on a day like today, with what happened with the employment numbers and so forth, I don't know if this is the day I want to be upgrading them unless you're trying to make a name for yourself. Apple broke its fib line. Okay. You could have taken a directional trade, and this one would have worked well. We did a credit spread on it, got 36 cents, and we were protected. We sold the 52.5. So we were protected all the way up to here. As long as the stock stayed below there, we get to keep the premium we collected. We wound up giving 5 cents of it back just to get out of the trade. So it wound up at 30 cents on a 70-cent investment, basically. So if you look at it, if you put 70 cents in, you got 30 cents back. You're looking at what, 40% for a couple of hours on Apple. And for those of you that are thinking, well, Rob, it's only 31 cents. It's not that big a deal. Well, I guess the question you have to ask is, if you were walking down the street and you saw $31 on the floor, would you A, stop, bend over and pick it up? Or would you painfully work it so you got out of the way of that $31 to go absolutely nowhere near it? Right? Everyone's going to pick it up. Right?
Wait, what price do you think this happens at, that people start wanting to pick it up?
No, I said if you saw $31 on the floor, would you pick it up or would you just go past it? It's not worth my time.
I'd pick it up.
In a heartbeat. You're not Bill Gates, who's, they calculate every second. If he stopped to pick it up, it would cost him $8,000 or something. I don't know. I get it. Don't pick the $31 up. I'm not there. I'll pick it up. We're talking about a 40+% rate of return for the day. That's what it is. If that 31 bucks wasn't enough, put more money in. You didn't need to just put in 60, put in 600. We did 10 contracts. That's $300 for the day. It's not great, but that's one trade, right? And we're out. Nothing to worry about any longer. Life is good. I get to come here not wondering where my stocks are going, where they're moving. It worked wonderful. It's all a matter of finding a pattern, finding a system, right? So that was the first one, Aaron. Number 2 was Biogen. Everybody saw yesterday. Everybody saw yesterday Alzheimer's drug. What's going on there? Great move, but is a 100-point move on a $200 stock a little bit overdone? I thought so, and that's the way we called it this morning. I said, and I quote, I think it's overbaked. I think it went too far, and we're going to look to see if we get a retracement today, a pullback today. Do we want to take a trade on that? So we went ahead and looked at a bear call spread. Now, the call on the bear call spread, the way I called it out, was above 281, and that's because we have a fib level back here on these the previous fib we had, because this fib doesn't have anything at that level any longer. So we had to use a previous level. So we set above 281. I couldn't get the 281s. I wound up with the 280. So I was just below that line a little bit. I would have liked it higher, but I couldn't. So that meant I took on a little more risk, but I understood that risk going in. I knew where the safety was. Now I made a decision based on my own personal risk profile. Do I want to go here or not? And we did a credit spread, picked up $1.10 and got out of it for 20 cents. I mean, now, but it was a $5 increment. So it meant if I picked up $1, let's say I got $1, it's easy. If I picked up $1, that means I had $4 at risk. One of premium I took in, the other $4 is the risk. The difference between the two strikes, 280, 285, right? But we got out of that, and what are we looking at rate of return there? 20%, 18%, 22%, somewhere around there, without me having to do the math, right? But this was all based on understanding that those over movers, when you get stocks that have those big directional shifts, we look at them and say, are they really going to hold up, especially after the jobs number that came out today? Boom, right back down. Right?
Yeah, and I didn't actually, I don't know how I missed this. I guess the news where the stock went up like 30%. I know the stock makes crazy moves in the past. Basically, for anyone unfamiliar, Biogen, what's the ticker? BIIB, right?
Yes, BIIB.
BIIB has supposedly one of the there's no drugs on the market right now to really combat Alzheimer's. So it's, the first company that puts out a good Alzheimer's drug is going to make a gazillion dollars, because it's something that affects so many people. And as our population continues to age, will become even more important. But had some good news on their Alzheimer's drug. But the stock's made crazy moves like this before, right? Where it goes up a bunch, then comes down. Biotechs tend to do that in general, right, Rob?
Oh, absolutely. And we did Biogen yesterday. We took a Biogen trade. We took a trade on this yesterday on a credit spread. We did a bull put spread yesterday on this as well. So 2 days in a row, today and yesterday, we just, the news is out there. I'm going to follow it along. Now what? Well, Biogen comes back to this 264.54 level tomorrow, today's close, or tomorrow's open somewhere. What happens in the market tomorrow? Do we get a bounce in the market? Are we getting a bounce in the S&P? Awesome. Is Biogen moving up? I'm going to do another credit spread with an expiration again for tomorrow. Well, what if we break down? What if the market's down and Biogen breaks down? Fails below that level, retests and drops off. I'll do another credit spread. This will be a bear call spread instead of a bull put spread.
Yeah, and we'll have to take, because we've only got about 8 minutes left today. Maybe next week, Rob, will spend the first 10 minutes or so kind of going through some of these different spreads, because I think a lot of people, they want to learn about options, they'll learn about straight buying calls and buying puts, and that can be pretty... It's can be, I guess, kind of intimidating once you start learning, but I think people intuitively really understand buying calls and buying puts. But then the spreads is kind of that next level where you need to have someone like yourself who's been doing it a while to kind of walk you through it.
I agree. You're kind of turning your hat the opposite direction. That's what
I like that. I like that. Yeah.
You have to think about this in ways you've never done before. Even just buying a put. Think about that. The stock goes down and your option goes up in value. For some people, it absolutely blows their mind. Right? That can happen. A stock goes down and the value of the option goes up. Well, that's how it was designed. It's a put option.
Got it. All right, let's see. So we talked Apple, Biogen, talked S&P. Got about 5 minutes left. Any other stocks you got? Maybe we can take a couple from the chat if not.
Yeah, I mean, let's grab some from the chat. But the last one we did today was Google. Not a lot of premium on it. It was a student brought up one. First time I saw the student in our room this morning. He brought up Google. We did a 20-cent credit spread we took in on a $1 increment. We're still open right now, but I think it's only worth about 5 or 6 cents at this point. So other than that, I've not done any other setups for today.
All right. FC wants to see Eli Lilly, LLY, and Sava, or what is it? Cassava Bioscience, whatever that one is. I think might have moved with the Biogen news.
Right. So Eli Lilly moved off of the Biogen news. I did not look at this today, and I'm very disappointed in myself that I didn't, because this was also a mover from yesterday. We did a Lilly trade and a Biogen trade. Biogen, yeah. So Lilly yesterday. We didn't do Lilly today. So could this have worked the exact same way with an overreaction? Yes. Why? The biggest reason for it is, where did it close yesterday? Right near a key level, that fib level. We tried to stretch up today. We opened at the top of the candle, went just a tiny bit higher and failed. The bulls tried to fight. They lost. It dropped back. Credit spread on the opposite side of that fib line is the place to go. That right there is where you want to be as far as setting that credit spread up.
Oh, sorry. Go ahead.
That's good, but you've got some room to the downside. So caution, if you're trying to take this now, if you're not in, you're kind of in the middle of the trade, I would be caution, which is where I said the bud. But there are going to be those that want to jump in. Let it get back to a level. Let it get back up to the 335 3/4 or down to the 324 3/4 level first. Decide what it wants to be when it grows up, and then and only then do you go ahead and take the trade. There's no. I need to get a pair of dice and just keep them here, keep rolling them on the desk. When someone, one of my own students or someone asks me, "What do you think about this?" I don't know. Let's roll the dice and see what it says. Yes or no, up or down.
Yeah. Sorry, just catch up on the chat here. Super
Sure.
Spackman wants to look at some oil stocks, either BP or Exxon, XOM. I was looking at Oxy earlier. Oxy was showing some strength, I believe, up today, when I didn't really see much else up today. Yesterday, I don't know if you saw, people were making, oh, the breadth was so strong, 90% of stocks were up. It's like 90% of stocks are down today.
90 plus, right? So oil stocks have come down. They had their run, of course. We went ahead and the U.S. went ahead, the government, and released some of the critical stores, right? And that helped gas prices a bit. So we had this nice climb back up. We've now seen a continuation push to the downside. We paid $3.19 for gas in New York the other day. And had we wanted to wait on a line of 35 cars, we could have paid 25 cents less than that. I wasn't doing it. I don't need that $6 that bad. The time is more important to me. But I don't see anything here that says, ooh, we're going back up anytime soon. We are in a true bearish bias on our stock, which means our moving averages are all in the correct order to the downside, right? And we're looking at our next fib line to be this bottoming pattern that's right here. The last time we bottomed out down there, which is about 80 3/4, give or take. That's the next place I see it going. I would look for a break down below the 86.5 and then a move down to 80.5 from there.
Yeah, and sorry, not to bring any dirty fundamentals into your charts. I've been saying this, I think, about the energy stocks for the past couple months. I was like, it's actually a pretty, I think like not in terms of a short trade, but in terms of like a more, I guess, longer investment, is that if you think we're heading toward a full recession, either here in the United States or abroad, basically you can expect all these names to continue to fall, right? You can look back and see what the Chevrons, what the Exxon Mobils did during the 07-08 recession, just because across the board demand for oil and fuel goes down. But if you think we're not really heading there, then there's a chance that prices remain higher and supply is constrained and these companies do well over the next year or so.
Right, and there's that double-edged sword, Aaron, right? Because now what happens in December into January with the EU and Russian energy, if they do cut it off and stop supplying it, if this was an actual sabotage of the pipeline that just happened into Europe, those things will drive these companies back up because they're going to have to get more energy from somewhere. So it's that double-edged sword of what's going on out there. There's a lot of risk on either side for anything long-term. I have still not taken my first trade on Google yet. Thought about it yesterday, didn't take it. We're back down again today. I've still not entered after the split, and I don't normally wait this long to take the trade on it.
All right, sorry, Rob. I gotta address this comment in the chat. DRK Sid Trader saying we are in a recession, bud. When I said, if you think we're heading toward a full-blown recession, call it what you want to call it, right? I'm not trying to argue the economy's firing on all cylinders and everything's great, but we added jobs. We've added jobs actually the past 6 months. If you want to call this, if you want to call it a recession in the same, the same breath as the 07-08, it's not the same. What we've seen yet is not the same. We might be heading there. I don't know. I don't have a crystal ball. But what we've seen over the past 6 months, well, whatever you want to call it, fine. I'm not trying to argue again that everything's great. But you don't see that in true recessions, right? That you're adding hundreds of thousands of jobs each month.
Correct. It doesn't happen. And again, some people are saying that the numbers are off, the metrics that are used are not right. We're too far behind the 8 ball when we make the decision. And that may very well be. But according to the methodology that we use here, we're not in a recession at this point. There are recessionary traits. Yes. And I don't even know where we take interest rates at this point. I mean, in 2008, we got up in that 5.5%, 6% for the Fed rate. So where do we take them? Do we get beyond those numbers here? Are we going to jack these up? We're paying 11 and 12% for house buying. I mean, you could basically close the bank down because no one's going to be able to afford that. There's no way anybody can pay 10% of the as an interest rate. It's not going to happen.
No, not going to happen. Again, Rob, always a pleasure to get you on, man. We're coming up on 1 p.m. Tradinglikeaboss.com. I'm going to drop that link in the chat. Go check that out for more from Rob and other wealth builders. HQ, you have that screen pulled up. I'll pull that up there. Rob, always a pleasure to have you on, man.
Excellent. Yeah, remind me next week. We can jump right in with spreads. That'll work.
All right, beautiful. Next week, spreads. Stay tuned. Come back next Thursday to learn some option spreads with Mr. Rob Roy. Rob, enjoy the rest of your Thursday and have a great weekend.
You too. Take care, everyone.
All righty, y'all. That is it for Benzinga Live. Today, we'll be moving over to Stock Market Movers with Money Mitch starting right now. This stream will redirect you there, so you do not need to go anywhere. He'll be talking to Sean Richards, a freelance economist from the UK, at 1:15. So if you've been wondering what's going on with the sterling pound, what's going on with the British Central Bank, Sean Richards is your guy with Mitch here in about 15 minutes. And he'll also be talking to Lance Roberts, the chief strategist for RIA Advisors, at 1:45. So Mitch has some exciting interviews coming up that I'll be tuning in for. Hope to see you guys there as well. Again, I'll ask one final time to smash the like on the stream. Give me a follow on Twitter. And with that, we part ways. And I'll be back tomorrow, just a day away.
This is